The world's largest companies spend billions trying to predict every market tremor. Yet, the earthquake that just rattled the $1 trillion e-commerce giant didn't come from a rival, a trade war, or a sudden consumer revolt. It was triggered by a quiet bureaucratic move in Ottawa, Canada, a policy decision so technical, so deeply buried in the nation's regulatory code, that it initially looked like nothing more than a domestic footnote. The global reaction, however, proves this was the geopolitical equivalent of lighting a fuse. The superficial news is about logistics, a subtle structural shift in how cross-border freight is processed and accounted for. But the deeper question is this: what happens when a medium-sized economy, operating within a massive free trade zone, weaponizes the very predictability that global corporations depend on? This isn't just a tax or a tariff. It's a re-engineering of the economic flowchart. For decades, the entire e-commerce model, the ability to promise instantaneous global movement while navigating national jurisdictions, relied on a tacit agreement of predictable, light-touch regulation. Canada's move has redefined predictability itself. It's an intellectual policy strike, using system-level variables to force a behavioral change from a behemoth. The surprising fact is that this isn't the first time a seemingly minor domestic policy has fractured a global system. In the early 2000s, a regulatory tweak regarding environmental liability in the EU fundamentally recosted the North American automotive supply chain, forcing a multi-billion-dollar redesign. What Canada has done is similarly systemic, but aimed directly at the velocity of digital-era capitalism. By quietly and suddenly changing the definition of de minimis values for certain cross-border shipments and adjusting liability for final-mile carriers, the government didn't raise the cost by $1. It introduced an unquantifiable variable: unpredictable friction. The logistics machine, built on speed and scale, cannot tolerate friction. This wasn't about revenue. It was about injecting an element of doubt into the psychological certainty of delivery times and cost assumptions. Why should you, the regular consumer, care about arcane regulatory code? Because you've been living in the age of implied subsidy. The promise of delivered tomorrow free shipping wasn't entirely free. It was predicated on an ultra-optimized, often hyper-aggressive global logistics pipeline that externalized many of its own costs and risks onto predictable national borders. Canada's action forces those costs of compliance, time, and border risk back onto the retailer, and eventually that cost returns to the consumer. More critically, it raises a question of sovereignty. Should a nation's infrastructure, roads, and customs personnel be optimized for the profit margin of one global retailer or for the priorities of its own citizens? This quiet policy move reclaims a piece of that economic sovereignty. The ripple effect is already spreading. Initial reports are showing a 7% drag on certain e-commerce transactions and a measurable increase in required inventory buffer stock across the continent. Amazon, having built its entire operating model on running the tightest ship possible, now faces a structural recosting in one of its most critical international markets. But the real consequence isn't the lost revenue in Canada. It's the dangerous precedent this sets for every other nation watching. Because if Canada can successfully recalibrate the DNA of e-commerce logistics, who will be the next country to quietly follow suit? The policy mechanism Canada utilized is known in trade circles as the de minimis threshold, a seemingly harmless customs rule dictating the minimum value of a shipment that can enter a country without formal tax or duty assessment. For years, major trading blocs have pushed this number higher, effectively lubricating the gears of cross-border e-commerce. It was a gift to the global logistics providers. Canada's quiet move was to strategically lower that threshold for certain high-volume, low-value categories, while simultaneously shifting the burden of compliance dramatically. This was not a tax increase, it was a paperwork bomb. The economics are elegant and, in a way, brutal. E-commerce logistics is built on the law of large numbers, shaving milliseconds and pennies off millions of transactions. Any policy that forces a pause, requires a new digital declaration, or shifts legal liability for a few cents worth of goods acts as a system-wide brake. Psychologically, Institutions like Amazon operate under the premise that local regulatory friction can be smoothed over with scale and lobbying. Canada's decision challenges this institutional psychology by proving that a nation can, in fact, create friction that is too granular, too decentralized, and too technically specific to be simply bought or bulldozed away. The hidden system here is policy-level attrition, a slow, steady, death by 1,000 regulatory cuts aimed at the logistical chassis of the organization. Here's the part nobody expected. This policy wasn't a standalone protectionist measure. It was cloaked in a broader, necessary update to digital trade facilitation, making it virtually unassailable under existing trade agreements. In the world of geopolitical maneuvers, this is a masterclass in exploiting a legal loophole to achieve a structural economic goal. The original intent of free trade agreements was to foster growth. The unanticipated consequence was creating the ultimate regulatory arbitrage environment for e-commerce. Canada, fully aware of its smaller size, didn't try to win a direct trade fight. Instead, it used the system's own design principles, the need for consistent documentation and local compliance, to force a costly operational slowdown on its largest trading partner's primary corporate champion. For the market analyst, the stakes are existential. Is the era of frictionless global retail over? If the Canadian precedent holds, we will see an end to the seamless logistics integration that defined the 2010s. This policy decision signals a fundamental shift in the risk-cost equation for any company moving physical goods across a border. It introduces a new form of border risk that isn't about tariffs, but about process time. This matters to every small business owner sourcing goods overseas, every manufacturer planning inventory, and every investor betting on global logistics stocks. The message is clear. The most efficient supply chain in the world is also the most fragile when confronted with targeted, sophisticated regulatory friction. The immediate impact is forcing major e-commerce players to fundamentally change their inventory strategy, moving from a single North American distribution model to a more costly, decentralized, and national model. They must now carry more stock in Canada rather than relying on rapid cross-border truck movements. This is a massive overnight capital expenditure that few analysts saw coming. But the real question is what this quiet action reveals about the future of national economic policy, and how this single policy shift has now put Washington and Brussels on notice. Across the Atlantic, policymakers in both the European Union and Southeast Asia are not just observing this Canadian move, they are actively dissecting it. For years, nations have been struggling to find a legitimate, politically palatable mechanism to reassert control over digital commerce without violating powerful international trade agreements. Canada just handed them the blueprint. The psychology here echoes a long-standing pattern in global commerce: the pushback against the dominant logistical power. Historically, from the Dutch East India Company to the British Empire's control of shipping lanes, the power to move goods was the power to dictate terms. Nations are realizing that in the digital era, the control of logistics friction is the new economic weapon. The collective frustration of nations overseeing sales taxes, labor standards, and consumer data flow out of their jurisdiction, enabled by hyper-efficient cross-border logistics, has been building. Canada's move is a highly sophisticated 21st century form of reclaiming the harbor. It's an assertion of national digital economic self-determination, masked as a customs procedure update. The historical parallel that truly escalates the tension is the regulatory fragmentation of the mid-1990s. Before the creation of the euro and harmonized EU regulations, a similar patchwork of national-level rules and standards created immense barriers for companies trying to scale across Europe. This policy-level balkanization ultimately forced major multinational firms to either lobby for deeper integration or create dedicated national-level operations, increasing costs significantly. Canada's action is an intentional, strategic rebalkanization of the North American logistics market. It weaponizes the concept of regulatory divergence. Furthermore, the move is quietly supported by domestic Canadian carriers and retailers who have long complained of being unable to compete against the implied subsidy of frictionless cross-border e-commerce. This is not just a government decision, it is a calculated industry intervention. This matters to every investor and business leader because it introduces a high-stakes element of loss aversion into the corporate planning calculus. Global firms have historically priced in regulatory risk as a constant, predictable expense. Canada has made it a sudden, unpredictable operational cost. This psychological shift, from managing a predictable risk to avoiding a sudden, unpredictable loss, forces a massive reevaluation of expansion plans, capital allocation, and supply chain design across all sectors. The age of building a single distribution center and declaring yourself global is over. We are entering an era of mandated localized presence. The lesson: nations will use subtle policy tools to force the creation of local jobs and local infrastructure, effectively nationalizing the global supply chain, one bureaucratic rule at a time. The biggest threat to Amazon is not the lost revenue in Canada, but the contagion. Every government is now watching to see how the e-commerce titan responds. If Amazon is forced to comply with this new level of regulatory friction, it legitimizes the policy blueprint for dozens of other nations currently grappling with how to regulate the digital economy. The quiet trigger in Canada is rapidly evolving into a global policy signal. But it gets deeper. This isn't just about goods and taxes. The true leverage lies in the data that these new customs requirements now mandate. Forget the stock market volatility for a moment. The immediate human consequence of this policy shift is already being felt in the places the media rarely covers: the loading docks, the trucking routes, and the hiring offices. The most significant real-world impact is the sudden, immediate demand for a specific type of labor: compliance specialists. When the flow of goods is frictionless, you need people to move boxes fast. When the flow of goods is suddenly full of friction, requiring new digital declarations, liability audits, and specific documentation for low-value items, you need people to manage paperwork fast. This Canadian policy is not just forcing a new inventory strategy, it's forcing a massive, unexpected investment in non-revenue generating, purely compliance-focused personnel. This psychological effect ripples through the labor market. The hyper-efficient, highly automated logistics industry is suddenly forced to become less efficient and more human-intensive in the least productive ways. The system is trading automated speed for human-level compliance, raising the underlying cost of labor for every delivered item. The part the media isn't discussing is the collateral damage to smaller enterprises. While Amazon has the capital to hire 1,000 new compliance officers, the smaller third-party sellers on their platform, the true backbone of the e-commerce economy, do not. They are the ones being hit hardest by the new complex documentation and the sudden risk of delayed or rejected shipments. The policy, while aimed at recalibrating the behavior of a trillion-dollar entity, is having an immediate, disproportionate negative impact on small to medium-sized businesses trying to scale across the border. This is the tragic paradox of systemic policy shifts. They are often designed to level the playing field, but the cost of compliance often ends up crushing the very players they intended to help. For families and workers, this is the beginning of the great repricing of convenience. The era of anything, anytime, anywhere, immediately is fundamentally shifting. Convenience, once an expected feature of digital life, is becoming a premium service again, explicitly priced to account for national jurisdiction and regulatory risk. The policy decision in Canada is serving as a powerful cognitive interruption, reminding the hyper-connected consumer that the digital infrastructure they rely on is, in fact, built on tangible national infrastructure, and that national governments have the ultimate authority to pull the emergency brake. This structural shift towards mandated localization is the biggest signal of a new era of economic nationalism. The quiet trigger in Canada has done more than just raise shipping costs. It has revealed a systemic vulnerability in the hyper-efficient, friction-free model of global digital commerce. It proves that national sovereignty, when applied with technical precision, is the ultimate leverage against global scale. The market is now focused on how Amazon will adjust its quarterly forecast, but that is the wrong focus. Because while the world is fixated on the price of delivery across the 49th parallel, the real transformation is already unfolding, quietly and in a sector no one expects. The global movement of digital services and data, which is about to face its own policy reckoning.